Welcome back to another episode of Unpacking Transfer Pricing series, where we aim to demystify complex transfer pricing concepts for our listeners who are interested in transfer pricing. Today, we will broadly discuss Chapter 7, Special Consideration for Intragroup Services, as recommended by the OECD Transfer Pricing Guidelines issued in 2022. Our goal today is to give you a high-level understanding of transfer pricing. This isn't professional advice, and for specific situations, one should always reach out to actual transfer pricing consultants. A link to a detailed audio-only description is available in the comment section below. So let's begin. Chapter 7 of the OECD TP Guidelines 2022 focuses on intragroup services. It provides guidance on determining arm's-length pricing for services within multinational enterprise groups. These services, whether administrative, technical, or financial, must adhere to the arm's-length principle, ensuring fair pricing and compliance with international standards. Intragroup services within multinational enterprises are typically provided by parent companies or designated centers. These services can be administrative, technical, financial, or commercial, and may be performed externally by appointing a third party or internally by using own resources. Whether in centralized or decentralized structures, they must adhere to the arm's-length principle as outlined in the OECD Transfer Pricing Guidelines 2022. Analyzing intragroup services in transfer pricing involves two key issues. First, determine if services have been rendered by applying the benefits test, ensuring that there is no shareholder activities and no service duplication. Second step is to establish arm's-length charges using direct or indirect charge methods as applicable, and consider a simplified approach for low-value adding services, if applicable as per the recommendations of OECD. The benefits test evaluates if an intragroup service provides economic or commercial value, akin to independent enterprises. Documentation is crucial for verification. The process involves assessing if the activity benefits a group member. Some tax authorities also consider need, rendition, benefit, and payment test to analyze the issue holistically, with special focus on whether the payment was as per arm's-length principle or not. Shareholder activities are distinct from intragroup services, as they arise from ownership interests. These include juridical structure costs like meetings and stock exchange listings, reporting requirements such as financial audits, fundraising costs, and tax compliance. These costs are borne at the shareholder level and are not to be charged to other group members. Duplication of services within a group is generally avoided and not chargeable unless used during reorganization or startup phases or to mitigate business risks. It's crucial to identify the nature and reasons for such duplication. Incidental benefits, like those from reorganization or acquisition, typically do not constitute intragroup services. Distinguishing passive association from active promotion is essential. Payments for unsolicited duplicative services can attract denial of deduction and tax and TP penalties. Centralized services from parent or regional headquarters usually encompass administrative, financial, commercial, human resources, and research and development functions. These include budgetary control, cash flow supervision, marketing support, recruitment, and research. Key factors to keep in mind from TP aspect is to avoid considering service duplication, shareholder activities, and incidental benefits, while adhering to the arm's-length principle. Determining arm's-length charges is crucial for associated enterprises. Direct charge methods require clear service identification and payment basis, aiding tax verification. They're suitable when services mirror those to independent parties. Indirect charge methods, used when direct charging is challenging, involve cost allocation and must adhere to sound accounting principles, ensuring benefits align with charges. Direct charge methods involve clear identification of specific services where cost is direct and identifiable, facilitating better arm's-length determination, and are suitable for significant business activities. Indirect charge methods apply when direct charging is challenging, using cost allocation and apportionment, requiring estimation, and based on usage measures. Key considerations include commercial sensitivity, safeguards against manipulation, and adherence to sound accounting principles. Low-value adding intragroup services are supportive, not core to the multinational enterprise group's business. They involve no unique intangibles or substantial risk. The simplified approach reduces compliance costs and provides tax certainty. Services qualifying as low-value adding can use reliable internal comparables, streamlining documentation. There is generally a list of services which qualifies for such low-value adding services. Core business activities, such research and development, procurement, core IT services, do not qualify as low-value adding services. Similarly, commercial activities, financial transactions, and senior management services are excluded. These require specific arm's-length pricing analysis under the OECD Guidelines. Low-value adding intragroup services include accounting tasks like financial statement preparation and operational audits. Human resources cover staffing, training, and payroll. Information technology support involves system maintenance and security. Tax obligations include tax return preparation and advice. Communications and public relations manage media relations. Legal services encompass contract drafting and legal consultation. These services must meet criteria in paragraph 7.45 of OECD TP Guidelines to qualify. The simplified approach for low-value adding services reduces compliance effort and cost, provides greater certainty, and enables efficient tax review. Identify low-value adding services using Section D.1 of the Guidelines and calculate the cost pool by summing costs per service category. Do ensure to consider direct and indirect costs before applying a 5% routine profit markup, and allocate costs using consistent allocation keys applicable to the service in question across the group or sub-holding level. For low-value adding intragroup services, calculate the cost pool by including direct and indirect costs, identifying accounting cost centers, and excluding one-to-one service costs. Select appropriate allocation keys, such as headcount or information technology users, based on service nature. Apply these keys consistently across all allocations and maintain the same key annually. Random changes in approach, if reflected in the audited financial statements or tax returns, can invite scrutiny. A 5% profit markup is applied uniformly to all low-value adding services, except pass-through costs. Tax administrations may set thresholds based on financial ratios or group-wide service costs to turnover ratio. Exceeding these thresholds necessitates a full analysis, ensuring the simplified approach remains reasonable. Documentation for low-value adding intragroup services requires detailed service descriptions, including categories, beneficiaries, and justifications, something that has been discussed in Episode 5 of this series. Written contracts between group members are essential. Cost documentation involves cost pool calculations and applied markups. Allocation keys must be justified and calculated. All documentation should be accessible to tax administrations upon request, ensuring compliance. With that, we conclude this episode. Until next, stay curious.